Welcome, Mr. Sonnie Ayere, the Group Chairman and CEO of Dundner and Milfield. Thank you for joining us today.
Thank you.
So, as a veteran in the market, you've obviously been involved in a lot of debt capital market, debt capital market projects and transactions. How important is the debt capital market to economic development?
It's a very good question. I actually started my foray into Nigeria by working with the government back in 2004. That was my IFC days, and I worked with the debt management office, to actually help them develop the bond market that you have today. And I think it's been a very successful venture. At the time, the idea was to have a system that allows for Nigeria to be able to mobilize its domestic savings, the biggest of that, of course, being pensions, and to be able to allocate, those savings very efficiently. And from our perspective, the most efficient way was the bond market, because that's where you have long-term, where you can invest on the long-term market. So I don't think it's possible for any country to have dreams, hopes, or any of that, of the above, of growing or evolving from a third to a second and a first world without having what I would call a well-developed debt market. Yeah.
That sounds very interesting. So one would therefore wonder, why hasn't the Nigerian debt capital market level of contribution to economic development risen to the level that it should? Obviously, Nigeria is very vibrant in all the economic activities. Why is the debt capital market not making that required impact?
I think it depends on how you look at it. If you look at it from a pure government perspective, 5 trillion, I think, is what the size is today. Now that's 5 trillion of borrowing that has gone into, to some extent, some capital projects. Some would argue mainly recurrent expenditure, etc. But I would ask any DFI, in the world to challenge the fact that they've been able to put in 5 trillion naira into Nigeria ever. So in other words, there has been some impact, 5 trillion of debt going out to 20 years. I mean, I think that is, something that I would commend. The problem, and as I said, you can look at it from 2 ways, is that the other side of the market, which normally should leverage on the government curve, is what has been lacking. My simple answer to that is that the interest rate structure that the country has effectively allowed government securities, for lack of a better word, to crowd out every other aspect of the what I would call the credit curve. And because of that, it's been very difficult for the other segments to actually benefit from the tenor extension that we now have. If you think about it, if you go back to 2004, when I started my foray in developing the debt capital markets for Nigeria, the longest tenor we had was 3 months of debt, treasury bills. That was how the government financed itself. And it was more like the government was just being punished, which is, at the time, I think treasury bills were generally between 16, 17, 18, sometimes percent. And the idea was really to then refinance these treasury bills into longer and longer and longer dated bonds, and to create a calendar and then put in the primary dealer market maker program that you have today, and so on and so forth. So there has been a lot of change, a lot of progress made. I mean, our market, to what I hear, is admired actually by quite a few African countries. But until we have a system, an interest rate structure that moves government debt, not reduce the size, but allows other issuers to take advantage of the debt market, it will be suboptimal. I dare say, and I'd go back to I think it was 2009, 10, we had the monetary policy rate then at 6%. And I do remember, at least my firm at the time, or our firm at the time, had been able to begin to get corporates to go to the market. That was when, for instance, we were able to achieve a 7-year floater with a cap and a floor for what I'd call a middle to large size corporate, all sold. So in other words, what it means is that where you have the right interest rate policy, it's inevitable that your corporates, your states, the municipals, and so on and so forth would be able to access the market.
So okay. I see there's a good understanding of what the issues are,
Correct.
Which I believe is why you were keen to be one of the vision team members that thought of putting this debt capital market together. So can you share with us what was the idea behind the vision team coming together to say, let's have this debt capital market workshop? What was the idea behind it?
I think, look, like everything in life, you begin a journey, and sometimes it's good to stop and take stock. Where are we? What are the lessons that we need to learn? And, how do we, take our market forward? The whole idea of this obviously came on the back of FMDQ, which again, I have to commend the MD, the visionaries behind the FMDQ, because I think bringing that into bank market, into some sort of official market, has been a very fantastic move for the debt capital markets. And sitting down and saying, okay, we know where we started from, and this is where we are today. How do we harness everything we have to move to the next level? I think, to my mind, that was the reason, and that was the thought process behind it. To get everyone to start, just take a step back. Let's look at where we've come from. Let's look at where we are, and let's put this together to take our markets to the next level.
So when this is done, obviously, there's going to be some form of resolution to say these are the things or the issues that we need to address, and these are the solutions that need to be effected to achieve this.
Correct.
How does the vision team intend to ensure that this is not going to be just another
Talk
print
shop
on paper report, but actualizing the resolutions that are taken?
It's a good point, because one thing I
sorry,
yes.
I want to change the shot. So before you answer, let me just change my shot. So that will happen. Okay.
Okay. All right. Great editing. Great editing.
Do I take that question again?
Yeah, I think so.
Yeah,
because it was the flow.
No, before he takes it, let me just ask a question. So he doesn't have to just ask him, not on the tape.
Okay, you can.
There you go. So just re-edit it. That's all.
Okay. So
yeah. All right. I mean, let's look at the key parties here. You have the Securities and Exchange Commission. You have the International Finance Corporation, my ex-employer. Then you have the members of the Vision Committee. I think, to my mind, the idea should be that you have these two organizations, or even three organizations that I've mentioned, as in SEC, IFC, and FMDQ. Sorry, that's the last. FMDQ actually take charge, with the committee providing support. My view would be that whatever decisions are taken, it would make sense that they are documented, responsibilities, assigned. And monitoring teams also, put in place. So you have a monitoring committee that's put in place to meet, whether it's once every quarter, where are we on A, B, C, or D. There's so many things that need to be discussed. I mean, the pre-workshop, for instance, at least the times I attended, had issues on tax, all kinds of areas that, there has to be a lot of advocacy, lobbying, and so on and so forth to make changes, and to allow it's like the oiling of the wheels of the market to be able to move forward. So I think that, to my mind, I think that's impossible. That's a great, in fact, a great team that I can see, because having international influence with the International Finance Corporation being part of this, FMDQ, which represents more or less the entire debt market, having SEC as a regulator, and then having, some of the key visionaries of the market there. I think you have a very, very good, strong team to push this forward if you want to.
Thank you. So finally,
Yeah.
what would you just say to intended participants at this workshop who will be attending? What message would you just give to them?
The young generation. I'd say, look, there is only one market. Unfortunately, and I hope by the time they're as they mature into the market, as they season into the market, we would move from the silos that we operate in today into one financial market, which looks at basically the short end, what I would call the middle end, and of course permanent capital, or the longer end of the market, equities. And don't go into a debt capital market thinking, okay, this is debt capital market and that's it. Markets are all interlinked, and the deeper you get into it, the more you begin to understand the wider implications and how markets actually work and are intertwined. And what I would want to see people get out of this is obviously a deeper understanding of the debt capital markets. But I would also like people to see how it actually links into the other markets, that exist, and so that people begin to think about one continuous curve. When you go into a trading floor, it's one trading floor, it's one market. A money market dealer will be asking a bond market dealer for the same, asset. For instance, where's that trading at? To have an idea of where this should be trading at, and knowing what a company has done at the short end also gives you an idea of what they're doing on the long end, and that's why when you look at a trading floor, you don't see, desks put in one component or one area locked away, another one no, they're all together, so they can actually interact. And I hope that people can begin to see that and see how markets truly work.
Thank you very much.
Merci beaucoup.